today, in our preparation for the SIE exam, we are covering a fundamental topic that often appears in various forms: margin accounts. Specifically, we will focus on the basics of how these accounts operate and the initial requirements set by Regulation T. A margin account allows an investor to use leverage, which is a powerful but risky tool. It means you can borrow money from your broker-dealer to purchase securities. By borrowing funds, you can increase your purchasing power and potentially amplify your returns. However, it's crucial to remember that leverage is a double-edged sword, as it also amplifies potential losses. To open a margin account, you must sign specific agreements. The two most important are the credit agreement and the hypothecation agreement. The credit agreement discloses all the terms of the loan you are taking from the brokerage firm, including the interest rate you'll pay, how it's calculated, and when it's charged. Think of it just like the terms and conditions for a credit card. The hypothecation agreement is where you pledge your securities as collateral for the loan. This is a critical point for the exam. By signing this agreement, you give the brokerage firm the right to sell your securities if you fail to meet your obligations. The firm can also rehypothecate your securities, meaning they can pledge them as collateral for their own loans from a bank, which is how they finance the loan to you. The cornerstone of margin regulation that you must know for the SIE exam is Regulation T of the Federal Reserve Board. Regulation T governs the extension of credit from broker-dealers to customers for the initial purchase of securities. It stipulates that you must deposit at least 50% of the market value of the securities you are purchasing. For example, if you want to buy $10,000 worth of a marginable stock, you must deposit at least $5,000 in cash. The remaining $5,000 is the loan from your broker-dealer. The exam will test this calculation directly. They might ask, a customer buys 100 shares of XYZ at $60 per share in a new margin account. What is the Regulation T call? The total purchase is $6,000, so the required deposit is 50%, which is $3,000. Now for a common trait. What if the purchase is small? FINRA, the self-regulatory organization, has its own rule. It requires a minimum initial deposit of $2,000, or 100% of the purchase price, whichever is less. Here is the key. A customer must meet the greater of the Regulation T requirement or the FINRA minimum. Let's say you buy $3,000 of stock. Regulation T requires $1,500. The FINRA rule requires $2,000. You must deposit the greater amount, so you would need to deposit $2,000. If you buy only $1,000 of stock, Reg T requires $500. But the FINRA rule requires 100%, or $1,000. You must deposit the full $1,000. So, remember to always check both rules and apply the higher requirement. To help you remember the main rule, think of the letter T in Regulation T as standing for transaction. It sets the terms for your initial transaction. A simple phrase to remember the 50% rule is Reg T says, pay half to play. It's a straightforward shortcut to remember that your initial contribution must be at least half of the total purchase value. Finally, be aware of the payment deadline. The deposit must be made promptly, which is defined as within 2 business days of the regular way settlement date. For stocks, settlement is 2 business days after the trade, so the deadline is 4 total business days after the trade date. Missing this deadline can lead to the firm freezing your account or liquidating your securities.